Financial statement disclosures. Disclosure are the compulsory part of the financial statements. If you see financial statement, balance sheet, income statement, cash flows, equity, this all is our summary pages. So we'll see what are the significant accounting policies that we need to use in preparing the financial statements. What is a segment reporting? How to do between the year reporting, that is called interim reporting. Related party disclosure means sister companies, the company who has common shareholders, so how to disclose them as separate. Unconditional purchase obligations, significant risk and uncertainties, subsequent events, and in the last we will see financial instrument disclosure. This is what is the topic of the day. Accounting policies are very important. Like if we see the financial statement, these are the summary statements. So from there we can't see that what policies we have used. So in notes we will define that what policies has been adopted when we prepare these financial statements. And this is also as per the accounting standards. So he says that management selects the policies as the most appropriate for fair presentation of the financial statements. Business and non-profit entities must disclose all significant accounting policies, the way you calculate depreciation, amortization, fair value adjustment. This is all has some policies in the mind of management. So this need to be disclosed. So disclosure of accounting policy in unauditing interim financial statement is not required, while in the full set a year time this is required to be disclosed. So what we can do is the preferred presentation is a summary of accounting policy in a separate section preceding the notes or the initial notes. So we will make a separate portion for explaining what accounting policies we have used. Disclosure should include accounting policies adopted and method of applying. So this is what is the mandatory requirement. And if you take any audited financial statement which is issued to the public, it will start with this, that what are the accounting policies used in these financial statements. So certain disclosures he says about policies are commonly required. What are the bases of consolidations? If it is a group environment where you have associates, you have mergers, you have acquisitions, you have subsidiaries, sometimes you have more than 50% shares, sometimes you have less than 50, more than 20%, then you have 0 to 20%. So there might be three scenarios. This is we will see when the consolidation chapters will come. Depreciation method, most of the businesses has depreciation. Even you are a small company, you have furniture, fixtures, so that subject to be depreciated. We have a lot of methods like straight line, reducing balance, double declining methods. So all methods, which method you use in accounts, that requires some disclosure. Amortization, so this I already told you how you recognize the profit on long term, short term, recognition of revenue, which standard you use, right? This all will be a part of your disclosure. Segment reporting is very interesting. If I suppose we are a company, we are like a store like Walmart, Sears, Carrefour, and we have several departments in one company. So how we are going to control the department wise profit and loss if we don't make a setup like this? So segment reporting, if you just show me this is your one column profit and loss, so how I will see which department is efficient, effective, which is in loss, which is in profit? So this segment reporting helps you to achieve that. First of all, you define a segment, then you disclose segment wise profit and loss, segment wise assets, liabilities, this way. So segment reporting make things easy for the decision makers. All accounting that we are doing, it's for the decision makers, so they can take effective decisions on the reports that we prepared, right? So he says that scope of segment extend to the interim financial report and annual financial statements. The objective is to provide information about different type of activities within an entity and the economic environment in which operates. So this is how segment reporting has become really important. So he says this approach is external and internal reporting is based on internal organizational structure. So you have to define, management has to define what are their segments, meaningful segments which make sense for the viewer of the financial statement. So it's all management judgment that which is segment and which is not the segment. But in any case, we have three characteristics that you have to understand. First, it's a business component of the entity that may earn revenue and incur cost. Because segment profit means that there is an income related to this product and there are expenses related to this product. Any point of time you have just a segment who has an income only and has no expense, so how you will do the profit segments, right? So segment should have income and expenses associated with that. Its operating results are regularly viewed by entity chief operating decision makers, right? So this is shortly we call say CODM for the purpose of resource allocation and performance assessment. This is also good. It's a separate financial information is available. So if you are using Oracle, SAP, so what we do is we define the cost centers, or you can consider it as a segment as well. Income, when we enter, we choose which segment it is, and when we enter the expense, we allocate it on the right. So when we run a report segment wise, so it gives us in column, you choose total, opening balance, closing balance. This is all the options should be available in our system. Operating segment may be aggregated if doing so is consistent with the objective. Sometimes you can feel that there is no value to do it in a minute detail. You want to aggregate it, consolidate it, if it makes sense and it has some logics, so you can do it as well. Then he says that to test, like what is the test? One is revenue, one is asset, one is profit and loss. So we see what is the segment. For example, what is my total revenue? And if it is exceeding 10% of the sales, for example, in the revenue, then it will be a segment. If it is just 2% of your total income, no need to make segment, right? Because it's not going to give a value to you. You make and do, we have systems, right? But as per accounting standards, we have a requirement that is going to do it. Revenue test, reported revenue includes sales to external customer and inter-segment sales. So you will define your sale, external customer, then you will make a section, inter-party sales. So this has to be in two sections. If you mix it, it will be misleading because inter-company transactions are subject to more strict regulations than to a normal customer and supplier. So he says that if it is exceeding 10%, it at least 10% of the combined revenue, then it is a segment according to a revenue test, right? Then we can have an asset test. For example, this is a segment, it has assets, total assets 1 million, your assets are 200,000, so it's exceeding 10%, right? So you can do that way. Assets are at least 10% of the combined asset of all operating and profit segments. Third is profit and loss. So you can take a profit and loss, take full profit, take the 10% of this. If it exceeding, then you are a profit and loss basis segment. Otherwise, no need to show you separate.